Let me talk about the global economy, where we've been and where we're going. Of course, it's only a couple of years since we came through the worst phase of the global financial crisis. I think the worst phase was from around about September 2008 through to March 2009. So we're just beyond the second anniversary of that worst phase. And of course, that was the period where we almost didn't have a banking system, where we nearly had banking meltdown. The supermarket shelves nearly didn't get restocked, the cash machines nearly didn't get refilled, wages and salaries almost didn't get paid over that period. Really serious, really scary, and a nasty period for us all, which I'm sure we all remember. We'll always remember that period in 2008-9. Very scary indeed for everybody. And one way I think of describing it, and I'm sorry if this chart is not that clear to people at the back, but I think of this as a kind of heart monitor for the global economy. And it simply measures the spread between money market interest rates and the interest rates set by central banks. And if you can just make out in the far left-hand corner there of this chart, that's the pre-crisis era, where there's virtually no gap at all, no margin between central bank interest rates and money market interest rates. That's sort of pre-crisis normality. Then you get the first wave of the crisis coming through in the summer of 2007, and of course that did for Northern Rock. Later in 2007, a great liquidity scramble, the second wave of the crisis. Through 2008, March 2008, of course, Bear Stearns has to be rescued. And then the heart attack moment for the global economy, September, October 2008, the failure of Lehman Brothers leads to calamitous conditions in the money markets and pretty quickly calamitous conditions in the global economy. You can see, and this chart could be taken on a bit further, that we've returned to a semblance of normality since then. Of course, that's with a lot of central bank support, a lot of government support, but things are infinitely better than they were a couple of years ago. However, this crisis, this meltdown, this freezing up of money markets had economic consequences, and they were pretty severe economic consequences. So, as a result of what I call the falling off a cliff moment for the global economy, went from September 2008 through to the spring and summer of 2009, we saw the worst recession of the post-war era, and believe it or not, the first down year for global GDP since 1945. So we'd obviously had previous recessions in the post-war era, but most of those had been growth recessions. We'd seen a sharp slowdown in global growth, maybe to 1 or 2%. This was the first year that we'd actually seen a fall in global GDP. You can see that that fall was more pronounced in advanced economies than emerging economies. That's a theme I'll come on to in a second. But also, the reason it was so severe, so savage, was that, unusually, everybody went down together. Everybody suffered the same fate simultaneously. You think of a normal global recession, America goes into recession, 6 or 9 months later Europe does, maybe a little bit later Asia does, by which time America is pulling out. There's a kind of ripple effect that occurs. That wasn't the case in the autumn of 2008. Everybody went down together, which is why the global recession was so severe. The transmission mechanism of that crisis was through the money markets, through the banking system, but also through world trade. And this collapse in world trade, again, that we saw in the autumn of 2008, for a while in that period, world trade was falling at a more rapid rate than at the onset of the Great Depression. And the great fear was that this would breed the kind of responses that we saw in the Depression. Protectionism, countries trying to protect their own, and that ingrains the downturn in world trade. You never recover. That was the danger. And I can tell you that world trade fell by around about 12% in 2009. Again, off the scale in terms of post-war experience. Previous post-war recessions, we'd only seen a 1 or 2% fall in world trade. 12% was much more severe than we'd seen before. Now, things are not as bad as that now. I hesitate sometimes to use the famous Norman Lamont phrase about green shoots. You may remember, most of you are too young, but you may remember that in the early 1990s, he kept claiming to spot those green shoots, and when anybody else went to look for them, they weren't there anymore. But it's safe to use them now because there are plenty of global green shoots around, even if you don't always get that impression reading the papers or listening to the BBC watching the BBC, watching Sky, watching anyone else. So it's not always a message that comes over from my colleagues in the media, but there is a global recovery, and it's a pretty strong global recovery. And one way of measuring that, people may or may not be familiar with these measures, these indices, which are called purchasing managers' indices, and they simply measure business-to-business activity. They're known in the jargon as diffusion indices, so there's no index base, but the way they work is that when the level of these indices is above 50, you're in a period of economic growth. When you're below 50, you're in recession. You can see the severity of the dive into recession that occurred in the second half of 2008. But you can also see how quickly the global economy came round again. So by the middle of 2009, in other words, almost 2 years ago, the global economy started recovering again, and it's been a pretty good global recovery. So after that first down year that we saw in 2009, global economic growth in 2010 was of the order of 5%, which is pretty close to what we had before the crisis. And this year, it looks, despite all the problems we've got, and I will talk about some of those, it looks as though we'll get global growth of 4.5%. It's been a good bounce back in the global economy. And I suppose the most encouraging thing I can say, and the most encouraging indicator for me, is what happened to world trade. You know, world trade could have gone down and stayed down. We could have had the protectionism. We could have had the 1930s response. Instead, it's bounced back and bounced back very quickly. So 2009, a 12% drop in world trade. 2010, 13% growth. You know, it made up for the fall. We're already beyond pre-crisis levels of global trade. The bounce back has been very sudden and very encouraging. I think one thing to bear in mind, and I'm sure as you know, investors and fund managers are fully aware of this shift, but it's interesting to me, the shift in the balance of the global economy. You don't have to go back that far for a time when 2/3 of global economic growth was generated by the advanced economies. So economies like ours, the rest of Western Europe, North America, Japan, and so on. 1/3 came from the emerging world.